Welcome back after the break. You're watching Markets at Noon with me, Ankur Mishra and Mansi Dave. To make a sense of market, how it will perform in near term and long term, we have with us Rakshit Ranjan of Marcellus Investment Managers. Rakshit, hi. Particularly today's market, it is flip-flopping between red and green, and a similar sentiment is there for investors because there is not much action in market. It is remaining in a range bound mode for past month or so. What is your sense? What will drive the markets now? Even the earnings which has come so far has been not the way it used to be, at least in the last quarter. In fact, a dip is there till now, the earnings which has been disclosed.
Yes, good morning, good afternoon, and thank you for having me on your channel. So, to begin with, let me add to the context that you mentioned in terms of the earnings growth momentum, not just from last quarter to this quarter, but if you look at, let's say, Nifty 50's earnings over the 3-year period of FY21 to 24, it was as high as 24% annualized CAGR, right, for 3 long years. From there, in the last 5 quarters, or you can say 4 quarters plus the one ongoing, we've had a mid to high single digit earnings growth. So it's a massive moderation from mid 20s to mid to high single digit earnings growth for the market as a whole. The second piece, which is also a bit of a challenge for the broader market, is when you look at valuations at about 21, 22 times FY26 price to earnings, Nifty 50's P multiple is at nearing its cyclical high, right? So you've got a combination of moderating earnings at a time when valuations are at cyclical highs, which is why, as you rightly put it, there's uncertainty in terms of where the markets will go, and our thinking in that regard is this is the kind of a stock market which is ripe for bottom-up stock picking to outshine rather than breadth of the market or width of the market helping investors make money. And in that regard, I think you will see far more narrower market going forward over the next 2, 3, 4 years, where earnings surprises, whether or not with or without elevated valuations, but earnings surprises will drive share prices more than just overall sector, every company in that sector doing well, that kind of a market that we used to have till a year ago.
Hi, good afternoon. Mansi this side. I would like to drive our viewers' attention to the CCP's current portfolio, which has delivered EPS growth of 14% in FY25 compared to 6% for Nifty 50. Now, if you can throw some more light and enlighten us on the same, and how do we see Marcellus's CCP portfolio position amidst the various risks which we see in the markets currently?
Yes, no. So in CCP, we are very conscious of the risk of broader moderation in earnings growth for the stock market.
Okay, so we have a technical glitch. We'll try and connect Rakshit Ranjan once again. But yes, the CCP portfolio, which he was talking about, they expect a gap between the Nifty versus the strategy, and if you see the returns of their portfolio in comparison to the benchmarks, Ankur, it's really quite interesting, as we clearly see the CCP portfolio doing real good in comparison, and it has delivered a good EPS growth around 14%. On the same side, if you see the Nifty, it's 6%. So that's quite interesting.
And if you talk about even earnings, the compressing factors, weak consumption demand, slowdown in building materials, high competition and supply side shortages are something which has been highlighted. Rakshit, hi, we were discussing about your strategy, CCP portfolio. Please continue.
Yes, no, so I was saying we are very consciously choosing stocks bottom up, where the return on capital employed to begin with shouldn't be backed by tailwinds of macro. They should be backed by competitive advantages of companies, because macro tailwinds, as we are discussing, earnings growth in the broader macro is moderating. Macro tailwinds are fading away. Hence, a lot more of competitive advantage oriented return on capital employed, and then a very high rate of reinvestment of that cash to drive growth. There are a couple of themes that are part of the portfolio. For instance, in terms of sectoral themes that become an outcome of the bottom-up stock picking, healthcare is a very big area where our allocations have increased in the last 1.5 years in the Marcellus CCP portfolio, and this includes hospitals, diagnostics, even health insurance, which is a little bit of a BFSI play, but on healthcare. And some pharma companies which are not just formulations doing generics or branded generics, but a lot of IP based competitive advantages in the pharma space. So that's one piece where the macro headwinds or lack of macro tailwinds is not a big concern, and hence it's a greater part of the portfolio. Otherwise, in the traditional sectors, let's say retail, consumption, financials, we are picking up companies where they're likely to gain share either because they are evolved supply side business models or demand side business models. For instance, let me take a simple example in consumption. Rather than the traditional modern retail format or the modern trade being the primary source of supply side, you've either got large format retail or the quick commerce and e-commerce players doing well, and hence orienting growth drivers towards the evolving sort of supply side and demand side of some of the traditional sectors is the second big area where we are constructing the portfolio.
Hi, you mentioned about quick commerce, and today Eternal is in focus continuously for 2 days. The stock has been on fire today, up around 10%. I want to understand this space particularly. How do you see this space faring up in the context of consumption theme? And also, there is a lot of fintech players which has come in this space. Do you think that competition will also weigh in?
Oh, yes, a lot of capital is chasing this space. As a result, you got to be patient if you want to make money out of prospective winners in this space. Having said that, the proof of the pudding is here. We can see sustainable disruption of the traditional channels, and quick commerce, e-commerce are not just fly-by-night disruptions which have come in that will go away. I think they'll sustain. So when you combine the two together, we do have businesses such as the one that you mentioned, where profitability is very volatile, given that it's in a high investment stage, early stages of scaling up. But I think if you've got clarity of thought on which will turn out to be the winners amongst all the options in such a space, there's a lot of returns for investors to be had. We haven't got exposure specifically to the stock that you mentioned, but we've got exposure via a job postings company, which is also investing in quick commerce companies like the one that you just mentioned. So yes, we are exposed here.
Okay. Rakshit, when do we expect the FIs come back? Because they have been extending selling spree, and a few sessions where we do see buying, the buying levels are also of very short quantum. Now the DIs are constantly trying to support the markets, but then the exposure of FIs more so is on the banks and financials and the IT. I agree that the IT results are not that great, and we still have a lot of results in IT, be the larger IT or the mid cap IT plays, but the banks and financials are doing good, right?
Yes, so first of all, I'm not an expert on FII DI flows, and there's so many moving parts here that every month the answer to your question on broader FII DI flows will be changing. Every month there are different factors at play which keep moving up and down. In terms of the sectors that you mentioned where FIIs have historically oriented themselves and the outlook of those, yes, you're right. IT services certainly is undergoing a very uncertain period in the interim. But I think once the transition is through, once the transition towards how AI applications and the entire GCC versus IT services balance, a few other factors that are playing out in the interim for IT services, once it all settles down, I think this sector will certainly continue to see growth. When it comes to banking, I think this sector has completely evolved in the last 12 months. Till a year ago, I would say pretty much all banks were reporting healthy deposit growth, credit growth, healthy net interest margins, NPAs, all sorts of parameters were pretty healthy for the broader industry. In the last 6 to 9 months, we've seen a separation again between the boys and the men in this space, where we haven't seen a massive NPA spike across the system, but the NPA progression of higher quality lenders versus the rest, the gap has widened a bit. Deposit growth, certainly it has widened a bit. And with interest rates falling, net interest margins will be another differentiating factor. Some companies will be able to manage the pressure on NIMs better than others. And that is again where you'll see the gap opening up. So men versus boys separation is underway. And I think whether or not that links into FII flows pumping into the high quality lenders, we'll have to wait and watch.
All right, so putting an analogy of men versus boys for the sector, thank you so much for joining at this hour and sharing your perspective. But